students, welcome to the lecture on classification of insurance. And after this lecture, we will be able to learn the following objectives. Explain life insurance, discuss group insurance, understand the basics of life insurance, describe growth of actuarial sciences, define the life insurance documents. Let's start with the concept of classification of insurance. The classification of insurance risks is an essential tool in the exercise of effective supervision of insurance companies. It is a means of categorizing insurance business for licensing purposes in order that the supervisory authority can ensure that only companies with sufficiently specialized expertise and the appropriate business framework conduct a particular type of insurance. It allows for additional licensing requirements to be imposed for certain insurance branches. Classification is the principal method by which variations may be imposed in relation to liability assessment, technical reserves, and investment rules in order to adequately reflect the differing level of risk pertaining to each type of insurance. It allows for differentiation of tax and duty rates, should the legislator so wish, in order to reflect national and business priorities. Let us now discuss life insurance. Life insurance is a financial cover for a contingency linked with human life like death, disability, accident, retirement, etc. Human life is subject to risks of death and disability due to natural and accidental causes. When human life is lost or a person is disabled permanently or temporarily, there is loss of income to the household. Though human life cannot be valued, a monetary sum could be determined based on the loss of income in future years. Hence, in life insurance, the sum assured or the amount guaranteed to be paid in the event of a loss is by way of a benefit. Life insurance products provide a definite amount of money in case the life insured dies during the term of the policy or becomes disabled on account of an accident. Why you should buy life insurance? All of us face the following risks: dying too soon, living too long. Life insurance is needed to ensure that we immediate family has some financial support in the event of our demise, to finance your children's education and other needs, to have a savings plan for the future so that we have a constant source of income after retirement, to ensure that we have extra income when our earnings are reduced due to serious illness or accident, to provide for other financial contingencies and lifestyle requirements. Who needs life insurance? Primarily, anyone who has family to support and is an income earner needs life insurance. In view of the economic value of their contribution to the family, housewives too need life insurance cover. Even children can be considered for life insurance in view of their future income potential being at risk. Now moving on to the next topic, we will study group insurance. Group insurance is an insurance that covers a group of people usually who are the members of societies, employees of a common employer, or professionals in a common group. Group coverage can help reduce the problem of adverse selection by creating a pool of people eligible to purchase insurance that belong to the group for reasons other than for the purposes of obtaining insurance. In other words, people belong to the group not because they possess some high risk factor which makes them more apt to purchase insurance. Instead, they are in the group for reasons unrelated to insurance, such as all working for a particular employer. Group life insurance as life insurance offered by an employer or large-scale entity, that is, association or labor, to its workers or members. Group life insurance is typically offered as a piece of a larger employer or membership benefit package. By purchasing coverage through a provider or a wholesale basis for its members, the coverage costs each individual worker member much less than if they had to purchase an individual policy. People who elect coverage through the group policy receive a certificate of credible coverage, which will be necessary to provide to a subsequent insurance company in the event that the individual leaves the company or organization and terminates their coverage. A group insurance policy gives advantages of standardized coverage and very competitive premium rates. We can avail of group insurance policies that a group will belong to takes. Groups for this purpose can be employer-employee groups or non-employer-employee groups as defined by IRDA's group insurance guidelines. Examples are holders of the same credit card, savings bank account holders of a bank or members of the same social or cultural association, and so on. Let's know the basics of life insurance. There are two basic types of life insurance, term and cash value. Term life insurance is considered pure protection. When we buy term life insurance, we are buying insurance only on our life. There is no savings feature as there is with a value policy. If we die during the covered period or term of the policy, the insurance company will pay our beneficiaries the face value of the policy. The face value is the amount of money the beneficiaries receive if the insured person dies. The annual premium increases as the insured person gets older. Premium rates are based on the probability of death at each age level and on the insurance company's cost of doing business. The major advantage of term insurance for younger families is the opportunity to secure a lot of protection against the loss of the primary wage earner for relatively little cost. As people grow older, there is a greater likelihood or probability of death, so the premiums become quite high. Many older people stop paying for their term insurance since they no longer need to protect survivors from income loss. One variation on term insurance is a level term policy. Both the premium and the face value of the policy remain level in this type of policy. This is why it is called level term. The insured person pays the same premium throughout the term of coverage, say 20 years, and the amount the insurance company pays when the insured person dies remains constant. These policies have higher premiums for younger policy holders than traditional term policies, and the premium is less than the actual cost in the later years. The higher payments in the early years, together with the interest that is earned, serve to balance out the underpayment of the later years. Another variation is a decreasing term policy. The premium remains the same during the term of coverage as with level term insurance, but the face value paid out at death decreases each year. People frequently purchase this type of policy to cover a mortgage in case one of the family dies. The amount the insurance company pays out decreases over time, just as the mortgage debt decreases when homeowners make payments through the years. Some term insurance has a guaranteed renewability feature. This means the insured person does not have to take a medical test or otherwise prove insurability to continue coverage when the term of the policy expires. This feature is important if you plan to keep the coverage for longer than the original term. Cash value life insurance. A cash value life insurance offers protection plus a savings feature. As with term insurance, the insurance company pays the beneficiaries the face value policy insured person dies while the policy is in force. With most cash value policies, the premiums are the same each year as long as the policy is in force, unlike premiums for most term policies, which increase with the age of the insured person. Because part of the premium goes toward the savings feature, the insurance company charges more for a cash value policy than for a term policy with the same dollar coverage. The amount available in cash, loans or withdrawals is called the cash value or cash surrender value. There are many different kinds of cash value policies. Only 3 will be described here. The most popular type is the whole life policy. The insured person pays the same premium each year of his or her life, hence the term whole life, or until he or she reaches some specified age such as 85 or 90. As its name indicates, a limited payment policy requires the insured to pay a level or unchanging premium for a limited number of years, such as 20. The policy is then paid up. For the same coverage, the premiums are generally higher for a limited payment policy than for a whole life policy because the number of premiums is less. The primary difference between an endowment and a limited payment policy is that the insured can receive the face value of the endowment policy after making the last payment. In other words, the cash value of the policy is equal to the face value of the policy after all premiums are paid. For limited payment policies, the cash value is less than the face value after all premiums are paid. When a policy has a cash value or cash surrender value, the policy holder can do several things with the accumulated amount. Borrow up to the full amount of the cash value at a favorable interest rate. Cancel the policy and receive the cash value. Use the cash value to pay future premiums. Receive the cash value paid out over a period of years. When the policyholder dies, the insurance company deducts from the face value of the policy anything it paid out to him or her, such as a loan. The company then pays the remainder to the beneficiaries. People who have trouble saving may like the investment feature of cash value policies. Others believe they can do much better investing the difference in premiums between a term and cash value policy in their own savings and investment plans. Following are the factors of growth of actuarial sciences. Development of life insurance. History of insurance refers to the development of modern business insurance against risks, especially regarding ships, cargo and buildings, property and fire, death, life insurance, automobile accidents, auto, and the cost of medical treatment, health insurance. The industry has been profitable and has provided attractive employment opportunities for white-collar workers. It helps eliminate risks as when fire insurance companies demand safe practices and the availability of fire stations and hydrants, spread risks from the individual or single company to the larger community, and provides an important source of long-term finance for both the public and private sectors. Enhancing individual financial security. A study of human history reveals a universal desire for security. This quest for security has been a potent motivating force in material and cultural growth. Early societies relied exclusively on family and tribe cohesiveness for their security. With industrial development, this security source weakened, being augmented by privately purchased and government provided security programs. Among the private programs, life insurance has been a universal response. From the individual's perspective, life insurance offers many advantages. Life insurance guarantees to pay a stated sum to a family on the death of its income earner. In doing so, it affords families a measure of protection against the adverse financial consequences of premature death, gives individuals a greater sense of economic security, and can help reduce worry and distress and thereby increase initiative. No other privately purchased financial instrument can perform this function. Cash value life insurance can serve as a means through which individuals save. Many persons who might not otherwise save consistently will, nonetheless, regularly pay their life insurance premiums. Thus, life insurance might constitute type of quasi compulsory savings. Life insurance products, especially annuities, provide a convenient, if not unique, means by which individuals can make financial provisions for retirement. Life insurance can permit more favorable credit terms to borrowers, both individuals and businesses, and can decrease the risk of default. Life insurance can also minimize the financial disruption to businesses caused by the death of key employees. Easing the burden of government social welfare, spending private life insurance can supplement, if not substitute, for benefits provided by government. This assertion is substantiated by a significant negative correlation between social spending and life insurance premiums. Moreover, the sharp rise in life premiums in the OECD countries may be attributed in great part to the mounting financial difficulties on pension schemes. Governments can now concentrate their efforts on core social protection benefits while allowing individuals to choose for themselves their desired level and type of additional protection. Impact on economic development. Apart from the social role it plays, by relieving government of some of the burden of meeting financial security needs, life insurance can assist economic development in general and the development of financial markets in particular. Because they have thousands of policy holders, insurance companies are able to amass quantities of funds that are important in supporting investment and the national economy. They thereby serve as financial intermediaries between investors and economic agents that lack sufficient financing, households, businesses, and in some cases even governments. The emergence of this new type of intermediaries with features different from those of banks with regard to time frame of investment in particular makes a major contribution to the development of financial markets. In the OECD countries, insurance companies are the largest institutional investors. Quantitative impact on savings. A great many studies have looked at how the development of life insurance and funded pension schemes has impacted the level of aggregate savings. When such schemes are instituted, they generally have a positive effect. A number of arguments have been advanced to explain this. First, when they are instituted on a compulsory basis, contractual savings plans, life insurance, and pension funds raise the level of aggregate savings if they involve a rate of mandatory savings that is higher than the rate for which households would have opted voluntarily. Qualitative impact on savings. While there may be some doubt as to the quantitative impact on the savings of the development of life insurance, the qualitative impact is very clear. Unlike many commercial banks specializing in deposit taking and short-term lending, contractual savings institutions usually adopt a longer term perspective. Their longer term commitments and the stability of their cash flow provide ideal sources of term financing for governments and businesses. Impact on the development of financial markets. Specialization in the sector insofar as the banking system is making adjustments in order to reap the benefits of its comparative advantage on short-term products. This has promoted a sharp reduction in risk stemming from maturity differentials between bank assets and liabilities. The stability of the banking system is therefore reinforced. Reduction of the differential between short and long-term interest rates, the rate curve is becoming flatter. This is prompting an improvement in the financial structure of business enterprises thanks to a lowering of the cost of long-term capital and a lessening of the risks of refinancing. Reduction of the implicit debt of defined benefit pension schemes. The contract for the life insurance starts with the proposal made by the proposer in standard application form available with insurance company, and then various other documents are prepared. Proposal form. The proposal form is a standardized form. The proposal form is a type of an application form which a proposer has to fill all the relevant details about the life to be assured. The agent has the proposal form with him provided by the insurer. There are different types of policies, and so the different types of proposal forms are there. It has the entire details regarding the duration of the policy, type of plan, mode of payment, etc. A proposal form is to be completed by the proposer in his own handwriting and signed in the presence of the agent. The proposal form contains a declaration at the end to ensure the authenticity of the information given. Usually, the proposal form contains the following information to be filled by the prospective insured: name of life assured, address, date of birth, occupation, age, name of the employer if any, sum assured of the proposed policy, number and age of the family members, family medical history, proposer's medical history. First premium receipt, the agent provides the proposal form and other related documents, and the underwriter examines the form and other documents and then determines the terms on which to accept the risk or reject the same. The consent of the person assured is obtained in the form of payment of premium. After receiving the payment, the insurance company issues the first premium receipt, which acknowledges the proposal of the life assured. It contains all particulars of the policy. It has the details of the next premium to be paid. The policy bond is sent within 45 to 50 days from the date of first premium receipt to the life assured. The first premium receipt is an important and powerful document on the basis of which the life assured can ask the insurer to issue the policy bond, which is treated as evidence of the contract of life assurance. Policy bond. After issuing the first premium receipt, the next step is that of the insurer of sending the policy bond to the life assured, and this document is also known as policy contract, which is the ultimate evidence of the life assured. The policy contract contains all the terms and conditions of the contract between insurance company and the life assured, duly stamped as per the Indian Stamp Act. The policy is sent to the life assured by the insurer. Life insurance policies can be grouped into the following categories. Term policy. We can choose to have protection for a set period of time with term insurance. In the event of death or total and permanent disability, if the benefit is offered, we dependents shall be paid a benefit. In term insurance, no benefit is normally payable if the life assured survives the term. Term assurance policy has the following features. it provides a risk cover only for a prescribed period. Usually, these policies are short-term plans and the term ranges from 1 year onwards. If the policyholder survives till the end of this period, the risk cover lapses and no insurance benefit payment is made to him. The amount of premium to be paid for these policies is lower than all other life insurance policies. As savings and reserves are not accumulated under this policy, it has no surrender value and loan or paid up values are not allowed on these policies. Whole life policy. With whole life insurance, we are guaranteed lifelong protection. Whole life insurance pays out a death benefit, so we can be assured that family is protected against financial loss that can happen after death. It is also an ideal way of creating an estate for heirs as inheritance. Term insurance is a type of life insurance that provides pure protection only. It insures an individual against the risk of financial loss in case of death. It does not include a savings plan. It is strictly an insurance protection contract similar to auto, home or health insurance. The owner buys a certain amount of coverage and pays an annual premium based on the insured's age. As the name suggests, this policy covers the insured for a certain term or period of time. At the end of the term, the coverage stops unless the policy is renewed. The simplest form of life insurance protection is annually renewable term insurance. The owner of a term life insurance policy can continue protection for additional terms, but as he or she grows older, the premium per unit of coverage will increase for each new term. Here are the most commonly overlooked features of life insurance plans and why they are important to a policyholder. Waiver of premium. This feature pays the premium of a policy if the policyholder becomes seriously ill or disabled. Accelerated death benefit. This feature allows receiving cash advances against the death benefit of the policy if policyholder is diagnosed with a terminal illness. Riders can give policyholders additional benefits and increase peace of mind that if something goes wrong. Available riders vary by insurance company and policy, as do the rules for how they work. Costs also vary and depend on many factors, including age, health, and type of policy. We cannot list every option available, but here are some of the most used riders. Waiver of premium rider. With this rider, policyholder does not have to pay the premium if he becomes totally disabled and cannot work. The waiver expires often at age 60 or 65. While life insurance proceeds are paid at the time of death of the insured, the proceeds of an annuity can provide a policyholder with an income for as long as he or she lives. There are two types of annuities. The first is when you pay a lump sum to a life insurance company and they pay it out to you right away in periodic installments. This type is known as an immediate annuity. The payments to you start immediately. The second and more common is where money paid by a policyholder accumulates with interest over a period of time. If policyholder chooses, the accumulated amounts will then be paid out to him in periodic installments, usually when he retires, in order to supplement his retirement income. This type is known as a deferred annuity. The payments to him are deferred for a number of years.
Annuity basics. Anyone who has suffered a financial loss in the past few years needs to know that an annuity can be an important part of a solid retirement plan. That's because it can protect a portion of your retirement savings from market loss and help make sure some of your income lasts as long as you do. And with today's retirement realities, most new or soon-to-be retirees actually prefer protection over growth. In a recent study of baby boomers, when asked what features are most important in a financial product, their top 3 answers were protection against market loss, a guaranteed stream of income for life, and the ability to support a steady, predictable standard of living in retirement. Some annuities can provide all of those things. In fact, only annuities can offer the combination of principal protection and income for life. But let's start at the beginning. What exactly is an annuity? An annuity is an agreement between you and an insurance company. You give money to an insurance company, and in return, they give you a guarantee. With some annuities, that means guaranteed interest or guaranteed income in retirement for a set period of time, or, if you choose, for the rest of your life. In this way, it's similar to Social Security or a pension that you fund yourself. Think of it as part of your plan for guaranteed lifetime income. An annuity can do other things too. It can give your money the opportunity to grow tax-deferred. Some annuities can help protect your money from market risk. And annuities can also be customized with extra features known as riders that you can add for additional costs. Sort of like adding features to a new car. Some common riders include guaranteed lifetime income and the potential for increasing income in retirement to help protect against inflation. Keep in mind, all annuities involve insurance-related fees and charges, and because they're long-term contracts designed for retirement, there may also be fees or penalties for taking money out early, including surrender charges, and if you're under the age of 59 and a half, a 10% federal tax penalty, which means you may lose some of your principal in some instances. Different types of annuities are designed to do different things. If you want protection from market loss and the predictability of knowing exactly how much interest and income you'll receive, a fixed annuity may appeal to you. Fixed annuities earn steady or fixed interest for a specified period of time. They also protect your money from the drama of the stock market. If you want the safety of a fixed annuity with the potential for better long-term growth, a fixed index annuity may interest you. Fixed index annuities provide the same type of protection as traditional fixed annuities, along with the potential for higher interest based on positive changes in an external index like the S&P 500. However, you are not actually participating in the market, and there are limits to how much interest you may earn. In other words, fixed index annuities offer the protection of a fixed annuity with more upside potential. Now, if you want the possibility of even greater returns, and you're willing to assume more risk than with fixed or fixed index annuities, then a variable annuity might be right for you. A variable annuity's growth is based primarily on your chosen investment allocations, so it offers more growth potential. It also carries risk because you're invested in the market, so you will experience both market ups and downs, and you could lose money. However, most people purchase optional riders to help reduce this risk. There are also investment fees associated with variable annuities that vary depending on your investment choices. Annuities generally have 2 phases. First, you're building up your retirement savings, which have the opportunity to grow tax-deferred through credited interest or investment returns. This is known as the accumulation phase. Then, you'll start receiving money from your annuity, helping you to live your retirement the way you want. This is known as the income phase, and of course you'll owe income tax on any taxable portion. So to summarize, an annuity is an insurance product that can protect a portion of your retirement savings and provide you with steady, some even increasing income in retirement for the rest of your life. Think of it as part of your plan for guaranteed lifetime income.
Now in the end, let us summarize what we have learned in this lecture. History of insurance refers to the development of modern business insurance against risks, especially regarding ships, cargo and buildings. Life insurance is a financial cover for a contingency linked with human life, like death, disability, accident, retirement, etc. To ensure that we immediate family has some financial support in the event of our demise. Group insurance is an insurance that covers a group of people, usually who are the members of societies, employees of a common employer or professionals in a common group. An endowment policy is a savings-linked insurance policy with a specific maturity date.